Welcome everyone. So I'm Christina Liu, Director and Vice Chair at CFA Society New Zealand. Thanks everyone for joining us. It's great to have so many, over 300 people registered to attend this, and also including attendees who have joined us from Blockchain New Zealand as well. So welcome everyone. Thanks for taking the time to join us on this webinar. Now, decentralized finance is certainly a topic of interest and its implications for financial transactions. So really keen to hear more about this disruption to financial systems. With us today, we have, I'll just briefly introduce the speakers. So firstly, Bryan Ventura, moderating today's session, an expert in this field. Bryan is a Senior Associate at MinterEllisonRuddWatts and is the current Chair of Blockchain New Zealand. We also have Henrik Andersson, CFA. Henrik is a Chief Investment Officer at Apollo Capital, which is Australia's leading crypto asset investment firm. Also, we have Sorel Carr. Sorel is a commercial partner at the BNZ, specialising in high growth tech and fintech businesses. And last but not least, Remor. Will is a core unit facilitator, real world assets at MakerDAO. So thanks everyone for joining us. Over to you, Bryan.
Thanks, Christina. It's a pleasure to be a part of this impressive panel. I'll be moderating for today. Some small housekeeping, please. You can please put in any questions you have in the Q&A app at the bottom of the screen, and we'll answer those questions during the Q&A session at the end. We'll have three very interesting presentations from Henrik, from Will, and then Sorel, and they'll be presenting via PowerPoint. You're also welcome to ask me any regulatory questions, and I'll try to answer them during Q&A. Our first presenter for today is Henrik Andersson. He'll be talking about DeFi in general, and he'll be sharing his screen, I believe.
Yes, absolutely. But firstly, thank you so much to Bryan and Christina and the CFA Society New Zealand for hosting this event. I'm going to go ahead and share my screen. Hopefully you will be able to see my screen. So again, Apollo Capital is a crypto asset investment firm based here in Australia. And you basically see four values in the blockchain ecosystem: layer one blockchains, interoperability technology, decentralized finance or DeFi, and the NFT space. And today we will speak about the DeFi market. So I will skip the other kind of sections in this presentation and jump straight into DeFi. We've been investing into the DeFi market for in the last 4 years or so, before DeFi actually was called DeFi. We think that DeFi is one of the lower hanging fruit of something called smart contracts. So with Bitcoin, we think of Bitcoin as a digital gold, but with the introduction of Ethereum and other blockchains, you can basically run autonomous code that run on this global world computer, and you can do more complex things. And one of those things are financial contracts, and those are the ones we call decentralized finance or DeFi. And here we'll just talk a bit about the size of the market today and the growth we have seen. So on that chart to the upper left, you can see the kind of total value in DeFi today. It sits around $65 billion US. It's been much higher just a little bit a while ago, 6 months ago. It was around $200 billion, that total value locked. We have had a decline in crypto markets in the past 6 months or so, since November last year, and that's reflected in DeFi as well. The DeFi market really got started in 2020. In the beginning of 2020, less than $1 billion was in the DeFi market. So it's been growing in the last 2.5 years by 65 times or so. To the chart on the upper right side, you can see the market share between different blockchains that are supporting DeFi. Ethereum has had a very big market share from the beginning, but then they got a lot of competitors from other blockchain. Ethereum became very expensive to use. There are scaling solutions coming out, but in the meantime, we've seen other blockchains taking market share. And in the table at the bottom, you can see sort of how the different blockchains ranks when it comes to capturing the DeFi market. Ethereum is still the most widely used platform. They have around 70% of the market share of DeFi, and other blockchains have a smaller part. Binance Smart Chain, Avalanche, Solana, Polygon, or other names that you might have heard. That's also supporting the DeFi market. So what is DeFi? So in DeFi, basically what you can do is that you can automate certain financial primitives using a special type of software. That's the software that are running on a blockchain, and it's powered by these smart contracts. And that means that we no longer need to trust a counterparty to transact with them, to trade with them, to make financial transactions. It can all be automated with software. And in that way, we can basically replace some of the middlemen in today's financial system with software. And there are different types of financial primitives that are being built in DeFi, and I'll list some of them here to the left, so you can see that there are exchanges built with DeFi. We call them decentralized exchanges or DEXs. There are derivatives platform or synthetic asset platforms. There are lending, borrowing platforms that are very popular in DeFi. There are insurance protocols, and there is even decentralized asset management protocols in DeFi being built. Some of the benefits with DeFi we have listed on the right side here. I'll just go through a few of them today. One thing is that DeFi is permissionless, meaning that these are platforms that are accessible through the internet, and really anyone that can access the internet can, in theory, access these different services. No one can really stop you from accessing them. You don't need to sign up. You don't need to create an account. Really, anyone in the world with an access to a smartphone and an internet service can access these different financial primitives. They're composable with each other, and by that we mean that you can build smart contracts that interact with other DeFi primitives, and they're like open and accessible by anyone. So a lot of the DeFi platforms out there, they are plugging into a number of different more simple DeFi primitives that have already been built and tested. They're non-custodial, meaning that you're not trusting a third party to hold your funds or hold your assets. You hold the private key yourself. And that again goes to back to that you don't have to trust a third party. Another category that I will mention is transparency as well. You have the full transparency on the blockchain, what's going on. So there is a saying in crypto that third parties are security holes. But in DeFi, you don't have to trust third parties, and everything is transparent on chain, on the blockchain, what's going on. So those are some of the benefits as we see it with DeFi. I'll just quickly talk about some of the different popular DeFi platforms out there. So I mentioned lending is one of the categories in DeFi. Aave is the biggest lending protocol out there. When I took this screenshot, they had $17 billion on the platform. With Aave, you can borrow assets against your portfolio, and you can do that to take leverage of your assets, or for example, to go short an asset, to borrow an asset and sell it. And again, you don't need an account. Anyone can access Aave to borrow against your portfolio, and no one can stop you for doing that. The interest rates are set automatically through the smart contracts, through the software itself. So the lending platforms have been some of the earliest kind of winners in the DeFi market. They have been one of the first ones to find product market fit in the DeFi space. You can see here that you can, for example, borrow a number of stablecoins against your Ethereum, and you can also lend assets to Aave. So if you have stablecoins, you can lend them on the Aave platform, and you can earn a yield because other people coming to the platform will borrow those assets. And when I took this screenshot on a popular stablecoin called USD coin, you can deposit that coin on Aave and earn a 7% interest rate. Another very popular category is what I mentioned, exchanges or decentralized exchanges. The biggest one is called Uniswap. Again, you don't need an account. You don't have to trust a third party. Usually, if you trade crypto assets, you need to create an account on a centralized exchange like Coinbase or Binance. You have to trust them with your assets. Using DeFi, you no longer have to trust an exchange with your assets. You can keep them in your wallet until you're ready to trade. And then if you are swapping assets on Uniswap, you can instantly swap one asset for another asset, and you don't have to trust a third party. It's also a much simpler way for people to trade than to have to log into an exchange, find your password, your 2FA, wait for your assets to arrive at the exchange, do the trade, and then withdraw assets from the exchange, wait for them to arrive in your wallet. On a DEX like Uniswap, you can instantly trade, and you don't have to wait for those assets to arrive at an exchange. This is the last category that I will talk about. That's the derivatives space. In the traditional world, we know that derivatives are trading much more than the spot market. We think the same thing will play out in DeFi market. The most popular derivatives exchange in DeFi is called DYDX, and you can trade on margin using DYDX. They are deployed on a scaling solution on top of Ethereum, and we think that those will potentially grow in value a lot in the future to sort of mirror what's happening in the traditional world. There are also other categories in DeFi that I will not mention right now, but for example, stablecoins are a core part of DeFi, and I think we'll hear more about stablecoins from some of the other presenters today. So I think I'll leave it there for now.
Thanks, Henrik. And I should add as well that nothing discussed during this webinar is financial advice or legal advice. Our next speaker is Remor, who's the APAC lead for global DeFi protocol MakerDAO. He'll be sharing his screen, I believe.
Just 1 sec. Yep, please let me, yep, if you just indicate as soon as you can see my screen, if you can.
I can see it. I can see your presentation.
Cool. Okay. So yeah, so welcome everybody. So for this part of the presentation, I'm gonna talk briefly about stablecoins. So we're gonna cover a few topics here. So first of all, like stablecoins and why do they actually even exist? I think it's almost self-explanatory, but it wasn't at the beginning of crypto or even DeFi to an extent. Then we're just briefly touch on the history of the stablecoins, how they have evolved. I'm gonna try. I think one important aspect is that actually now stablecoins are created equal. So we're briefly touch on them on the taxonomy of those, and then cover some of those by example. I'll probably cover a little bit more MakerDAO's DAI because it's my bread and butter, but I also touch on a couple of other examples, some of which have been in the media recently, and then I'll cover some of the real world applications that are beyond the crypto markets. Okay, so when we talk about stablecoin, what is it that the problem that we're really trying to solve? It's obvious nowadays, but it wasn't obvious at the creation of the crypto market. If you want a currency that actually can be used, you require it to be stable. And to this day, the global stability mechanism or the reserve currency is the US dollar. So up until a long time, and I'm sure people actually have seen people used to buy steel pizzas with Bitcoin in the early days of the network, and that's definitely not the case. So if you want to have like a unit of account and a meter exchange today, day to day, you actually have to have a mechanism that is stable. The history of stable coins started a long time ago, even much before actually I got involved from a professional perspective into this space, and even before, as Henrik was saying, way before actually the Ethereum ecosystem was even born. Some of the earliest attempts at it came from 2013, 2014. Some early projects that probably no one actually knows and nowadays, newbies, and some of those that actually still survive the time, like Tether. That evolution has been steady, but it also has been very fast, and especially over the last couple of years. We've seen the evolution of the capitalization of the stablecoin market grow from what used to be in the millions when I started, or even like in the thousands when I started actually working in the Ethereum ecosystem, to multi-million dollars to $1 billion of not only flow, but also in terms of the capitalization and the number of holders that actually use stable coins. the taxonomy of these stable coins, it's important to understand that not all stable coins are really created equal, and understanding them is really crucial, so that actually you can understand what the kind of like risks and shortcomings that come from each of the different models in there. So here we're gonna just talk about one way of categorizing them. It's not the only way, but is probably the most kind of popularized way, which is we categorize them by the kind of collateral that back those stable coins, which you can be a variety of forms from fiat money to algorithmically backed stable coins. We categorize by the value that is set as a reference. So be it the USD, the vast majority of them actually use the USD as their target value reference. And then we also characterize them in terms of the spectrum of decentralization. In terms of like that collateralization or the backing of them, we have two big categories. We have asset-backed stable coins, and we have the non-asset-backed stable coins. And here is just a few of those categorizations. So you can be either, fiat or more like treasuries, US treasury backed stable coins. You can have stable coins by commodities, real estates, or other types of physical assets. You can also have them either being non-physical assets such as crypto, either being off-chain assets such as shares and debt, or on-chain. And you can actually even have a variety that combines more than one of those types. On the non-asset back, I think the majority of people have heard, at least to an extent, algorithm stable coins, especially over the news over the last month. On the other aspect, or more like the spectrum of decentralization, we'll look at stable coins from at least a few angles. So actually that's really allows you to understand how they really work. So you could say, so from the operators or the issuers of those stable coins and how actually they really operates. Is this like a centralized counterparty or a decentralized counterparty? And how is the system of issuance and the system of actually observation of value? How does actually that really work? You also can observe it in terms of the collateral. Is that collateral custodied, or is that a collateral that runs on smart contracts? Depending on what answers you have from them, you also have different kinds of risks that come from answering those questions. And then of course, from governance, how is it that a issuance, the minting and burning aspect of a stablecoin actually really works? This is just a kind of a summary of this taxonomy of stablecoins. You have like a stablecoin trilemma between its stability, its decentralization, and its capital efficiency, and also have the mixes of between the fact that they are centralized, algorithm, or decentralized and over collateralized. I'm going to talk about some examples of these now. So the first one being DAI. So the answers of MakerDAO. MakerDAO is a leading DeFi protocol. It's the biggest DeFi protocol in the world, which issues its currency, the DAI, which enables borrowers to take over collateralized loans in DAI, and others to use that DAI in the crypto market. The protocol is native to the Ethereum blockchain, built on Ethereum smart contracts in a decentralized fashion, and DAI is actually the stable coin behind that protocol. There's a lot to unpack just from this single sentence here. I will probably leave a little bit more space for that in our discussion after the presentation. The way it works in basics is that DAI is soft pegged to the US dollar, and it's fully pegged, it's fully backed in terms of like this taxonomy by crypto collaterals, tokenized real world assets, and also other stable coins. And the lending protocol is managed by a set of smart contracts that are permissionless and open for anyone actually to see what's happening within them. The way DAI is in terms of like crypto, DAI is what we call like an over-collateralized stablecoin. So that means that for every DAI that is issued in the market, there is the notion of hard or soft assets that back it, but actually backed beyond the value of the DAI that is issued into the market. So when you borrow DAI in a similar way, you're locking your collateral into the system, and when you're paying that plus a essentially an interest rate, or we call it a stability fee. And the DAI is actually self-issued by for every single user of that currency. DAI has evolved over its history from a version 1 of it, which was really collateralized by crypto loans, towards what now we have is real world assets. I will skip a little bit like the intermediary phases of that, and I'm happy to cover that a little bit later. But essentially, DAI is one of those that is not only backed by one type of collateral, but it actually there's a basket of different types of collateral with different characteristics, and this is really the key of the lifeblood of how DAI has evolved. Another example, if you're an issuer of a stablecoin, I'm sure that people have seen these charts over the last month or so. This is exactly what you don't want your stablecoin to look like. This is what looks like when you lose trust in a market. And essentially, Terra was an example. It was actually a big example, but it was not the only example of a depegged stablecoin. This had happened over and over the history of stablecoins. In theory, it's the history of two stables, one that is minting and another one that is burning, to manage the pegging aspect. In reality, if you have a shorting position of the stablecoin, then you can actually enter into a death spiral of that stablecoin, and that what happens in the case of Luna, and actually how Luna is associated with the USD, is that once the market has lost the confidence in the value of Luna that backed the value of USD, people also lost confidence into the pegging of the underlying stablecoin, and that actually caused a loop that led to essentially the death of the first version of the algorithm stablecoin of Terra Luna, which is now trying to come back from the ashes. Just briefly, an example of a local market stablecoin. This is more like a traditional fiat-backed stablecoin than NZDS, and some people might have seen it. This is really based on the same underlying framework of Circle USDC, which I'm sure a lot of users actually have either used or seen in market. I'll skip some of these and go into the real world applications, because I think this is really where our evolution is leading us. So moving DAI from that first phase of crypto loans and stable coins to actually the real world. We know that the crypto loans are just the beginning for MakerDAO, and we have started our journey because the total size of the addressable market for crypto is just too small for a fully decentralized and global stablecoin like MakerDAO. So that figure has reduced significantly over the last couple of weeks, but $1 trillion market, it is against a total addressable size of a real world market. We're really not talking in the same scales, but we also understand that bridging things into the real world is a real challenge, and therefore we've taken Maker is a slow, steady, people actually call it the old ankle of DeFi. It's a slow, steady protocol that just builds for long-term sustainability. And our journey is really that over the last little while now, real world assets has become a real strategic strategy, a real strategic direction of the Maker protocol. The latest of it has been the refi of SocGen covered bond transactions, which essentially kind of really put MakerDAO into the institutional roadmap. Once SocGen, one of the biggest global banks, has actually approached Maker to refinance as the testing experiments part of its covered bond issuance through the Maker protocol in a decentralized fashion. I'll skip a little bit some of the underlying characteristics of how this really works, but I'm really happy to come back to it during the Q&A session. I just want to briefly touch on the fact that when you move from crypto-backed loans to real-world assets, you are talking about beasts that are of significantly different nature. In the case of stablecoin, where in the crypto markets everything is fungible and homogeneous, especially when it's built on the underlying platform like Ethereum. In the real-world side, things are much more messy and heterogeneous. It's also not directly callable in the same way with the same speed of the crypto markets, and it's fairly inflexible when it comes to its terms. As well, you also, where in the crypto markets, particularly from CFAs here attending, I think when in the crypto markets you're talking about liquidity risks and those types of runs on dApps. In the real world market, you introduce some risks that are not of the same nature, particularly actually credit risk. And when you have like a stable coin, which is actually the underlying trust of your protocol, you really have to take that very carefully. So I will stop there and leave the floor for the next presenter.
Thanks for that excellent presentation. And if anyone has any questions about the NZDS New Zealand dollar stablecoin, I'd be happy to answer them during Q&A. I was part of the legal team that helped design the structure for that. Our final presenter is Sorel Carr from BNZ. He'll be talking about TradFi and how it can interact with DeFi.
Cool. So I'll just share my screen and just when we say TradFi, it sounds like trade, T-R-A-D-E, but we actually mean traditional finance versus decentralized finance, just to clarify that. And you can see my presentation, the slide deck.
Yes.
Yeah, cool. So yeah, look, really great discussion so far, really insightful. So hard act to follow, and it's always fun being last. So today I'm going to talk about TradFi and DeFi, and maybe a more conceptual nature rather than a deep dive. It's a sort of a 10-minute talking slot, and it's a complex topic. So the idea here is to spark the conversation, and hopefully you can leave today having picked up some new info or angles to consider. So we'll talk about two things today, nice and easy. First, we'll cover off what blockchain can do for TradFi, so looking at the tech, and we'll look at a few use cases there. And then we'll move to thinking about how TradFi can collaborate with DeFi rather than the sort of pitting against each other that we sometimes hear about. So two things to talk about, nice and easy. So we'll jump straight in. So taking that step back from the topic of DeFi, looking at the underlying tech. Plenty of possible use cases for blockchain and traditional finance. Some of them are listed here, and I've highlighted a few that I think are probably more relevant than the others, and or at least higher up on the maturity curve in terms of implementation. And so the first one is payment rails, and we hear about this one a lot. It's probably the most commonly talked about. Lots of buzzwords and headlines around things like sending low-cost cross-border transfers using crypto to other countries like our neighbours in the Pacific, where current payment rails and platforms are typically expensive and clunky. Using blockchain and TradFi, the idea is that we could utilise tokens to send and settle transactions in a fast and low-cost manner on whatever the most suitable blockchain is. And if we look specifically at FX transactions, there's sort of two main schools of thought here. So scenario one is sending a token, for example, NZD stablecoin, NZDS, let's say, to a neighboring country, and then that token or stablecoin is received by the recipient and can be used directly over the counter. So they go down to the store and then they pay for the milk with the NZDS. This implies mass distribution and acceptance of that token as a currency, which on the whole, as a global population, we're moving towards that, but we're not there yet. And scenario two, which we're closer to, and we're starting to see some of that being implemented, is more a closed loop ecosystem where person A converts their New Zealand dollars into a token or stable coin. They make the transfer to person B, who converts that stable coin back into traditional currency, and there's this netting out mechanism in the background that settles the transaction. So a really good example is JP Morgan. They've launched JP Morgan JPM coin some time ago, and the version one of that is closed loop. So a JP Morgan wholesale customer can convert currency into the JPM coin, execute a transfer or transaction, and then the receiving counterparty, also a JP Morgan customer, gets that token and converts back out into the normal currency. And then JP Morgan settles out the transaction with a netting out exercise in the background. Remember, this is sort of conceptual in nature, and whilst they've done this, this presentation doesn't really focus on the regulatory hurdles and other hurdles like access to the technology. It's really just an idea dump, if you like. The next example is tokenizing of assets, and this is an interesting one because people talk about tokenizing as if it's a novel concept, but we've been dealing with forms of tokenization for, a long time. The certificate of title that you get issued with when you purchase your home, the piece of paper, that's a token, that's a representation of your ownership of that hard asset. So what we are talking about then in this context is just moving that token into a digital format, and the blockchain acts as the auditable ledger that tracks that ownership across that asset class and other asset classes. So in a traditional finance context, having this digital tokenization, that mechanism, it can improve efficiencies around taking collateral for loans. But the big thing is that it can open up new asset classes for funding providers to take security over. So that means consumers, a direct downstream effect of that is that consumers have more lending options because they've got, a multitude of assets that they can give to a funding provider as collateral in exchange for loans. And this is a really interesting example I give often, but it's conceivable that at some stage soon I could send Bryan or someone else on this call a token through my digital wallet that represents a full share or half share or whatever share ownership in this chair that I'm sitting on. And that's an extreme example, and given the dollar value of the chair, I don't think financial institutions would lend against it, but the principle is there, and you can apply that to fractionalized or full ownership of real estate, cars, all sorts of assets. And so that really opens up a world of trading assets efficiently, loaning against assets efficiently, and investing in different assets efficiently. And the next and final example that we'll go over, and one that's looked at less, is the lending tech stack. And being a banker, that's one I think about often. And when I say lending tech stack, I mean the banking lending tech stack. So what we as bankers use and other financial institutions use to sort of qualify through to approve and disperse a loan. So seeing where blockchain might be able to optimize that process. And so when a customer comes in and wants a loan, there's this internal process that's followed. and a lot of steps that require a lot of human input. And one of the most manual steps is towards the end, where you document the loan, and then the settlement process, where lawyers and bankers go back and forth satisfying requirements until there's this very manual sort of click send disbursement of funds. So this is where, for me, the use of smart contracts is a really exciting proposition or angle. A smart contract, Henrik and Will both actually touched on it before. It's basically sort of this if-then trigger that's coded. So if this thing happens, then that thing happens. So a back and forth scenario with lawyers to satisfy any number of requirements can, in principle, be coded. So all the thought of parameters are coded into a smart contract, and all outcomes are considered. And so that blockchain-based system, if then's its way to completion with a lot less human input. And that's what's really exciting to me, thinking about that efficiency. So those are a few use cases, and I want you to hold on to those, because that technology application is relevant to my next point, where we'll talk about how DeFi and TradFi can collaborate. So shifting that gear now, let's look at DeFi and TradFi together. And I think to do that, we need to ask a few questions to frame things up. And the reason we need to do that is because people often talk about as if it's one or the other. So DeFi will usurp TradFi, or DeFi is too risky, or whatever. And I don't think that's the case. I think it's probably somewhere in the middle. And when it comes down to it, I'm not convinced that consumers really care about where their capital comes from or what tech is being used. They probably care more about the experience and the output or impact of using a product or service, either for themselves or the environment around them. And that's important to remember. And that sort of talks to the idea that there's room for both DeFi and TradFi, as long as each model meets consumer needs. And so, taking that framing, let's look at some of the key differences between TradFi and DeFi. I want to go through all of them, and it's not an exhaustive list by any means, but a few of the key ones. So TradFi, and I think this is probably a reasonably neutral table from someone who's interested in both worlds. So TradFi, we've got this long tail onboarding and loan processes. So those functions, setting up an account with a bank or getting a loan with a bank and financial institution, these functions can take some time and be a little bit cumbersome. The traditional finance system is highly regulated, so banks and other institutions have KYC and AML requirements, they've got capital requirements, all sorts of stuff. But there's also a high level of trust and safety. You don't log online to your internet banking worrying about being hacked or losing your keys. And then, of course, it's localized ecosystem, so domestic private providers, banks and the like, down the street, not in Europe, although you might have a bank here in Europe if you have a mailing address and all the rest there. DeFi, on the other hand, so that's autonomous short tail onboarding. So, and I say onboarding in quotation marks because you don't need to apply for anything or open an account. You just get access by creating a wallet, and you own that wallet, which is distinctly different to the traditional finance system. That ecosystem is more unregulated or lightly regulated. So typically you don't need to provide your name, your email address, or any personal info, or very limited personal info. A DeFi platform also doesn't have the same capital requirements that, for example, a New Zealand bank has, and that talks to that regulation piece. You have Celsius as a live negative impact example, although that's not quite DeFi, but if you haven't seen that, that platform is having liquidity issues, and they've had to halt withdrawals, which may or may not have happened in a more regulated environment. I don't have the answer to that. But then, of course, if you have any sort of structural mishaps in the ecosystem, or hacks or scams like rug pulls, all that kind of stuff, at the moment there isn't a huge amount of recourse. Consumers are sort of left to their own devices. But on the flip side of that, you have some upside features like fast permissionless transacting at any time of the day. There's also the globalized component, and that feature on the whole gives the potential for consumers using the ecosystem to have greater access to more lending products and services than they might already have, or otherwise have, rather. And so you have this really contrasting dynamic where each financial system has stark pros and cons. And boiling it down, a financial utopia, if you like, for me anyway, is where you can have the best of both worlds. So if we can get TradFi up the curve on things like speed to market and access to markets, and when I say speed to market, I mean you come in from the bank, come in from the street, you can set up an account in minutes or less, like you can with the DeFi experience. Same with the lending experience. And when I say access to markets, I mean, in principle, there's no reason why we can't lend, aside, forgetting about regulation for a moment, and things like recourse. There's no reason why we couldn't or shouldn't be able to take a loan from someone in Brazil or whatever country if we want. And then on the DeFi side, I think the DeFi in general needs to get up the curve on customer safety and experience. And that's about making it easier to interact, easier for people to enter the ecosystem. And then the customer safety and experiences around adding in robust protections for the consumer. So if you can manage to do those in both ecosystems, you sort of end up having a little bit more of an integrated same experience approach. And you get the best of both worlds. And maybe that's easier said than done, but I think the starting point for this amalgamation or collaboration is connecting through the tech. And what I mean by that is actually the first point. So what we spoke about earlier with the use cases around bringing blockchain to traditional finance. That's really step one in my eyes. So, what's next in TradFi? And I say TradFi here because it's the incumbent, and there's an element of applying folding DeFi into that world as sort of a path of least resistance. Look, I think it's too early for wholesale changes. I don't think consumers on the whole want or need a complete upheaval into this more autonomous, higher risk / greater access environment. You are, however, seeing more and more people and institutions starting to play with the tech, which is nice to see. And I think that's the way to move closer to that, utopian financial systems future, where we can capitalize on all the best features. If there is a one-liner to take away from today, I think in the coming years or in the coming decade, we really have the opportunity to upgrade the plumbing of our financial system, both domestic and global, using blockchain tech. And if you play that out, you get to a point conceivably where TradFi and DeFi are using the same plumbing or infrastructure. And so from a customer experience point of view, it's customers plugging into the same ecosystem and having the choice between decentralized liquidity or centralized liquidity, decentralized ownership or centralized sort of custodianship, with the most efficient tech layer above that, and that's sort of smart contract driven. The underlying financial experience, the aesthetic of it, I don't think necessarily needs to change for customers, and I don't think consumers necessarily want that either. So yeah, hopefully at some point we have this globally accepted hybrid world where we really have the best features of both TradFi and DeFi. Look, it's really an exciting time to be involved in the world of finance in general, and that's all we have time for today. But look, if anyone wants to chat offline at any point about any of this, please do reach out. I love talking about this stuff. And like I said, it's a really complex topic. This is all really high level, high touch, but hopefully you've come away with something that's useful. Thank you.
Thanks, Sorel. That's a really thorough look at TradFi and how it can interact with DeFi. It's not often you can hear that level of expertise from a banker. So thanks for that. We've got a ton of questions, and we're now in the Q&A stage. I'll start with the first one, and I'll leave it to the panel to decide who can pick it up. How can counterparty risk be addressed in a decentralized exchange?
Yeah, maybe I can try to address that. So if you trade on a decentralized exchange, you actually receive, you send one token and you receive the other token in the same transaction. So you're not actually interacting with the counterparty as such. You're just interacting with, for example, Uniswap's smart contract in this instance. And you have other people who can provide liquidity to Uniswap to enable that to happen. But you never have to take that counterparty risk with any individual. You just changing tokens instantly.
Thanks, Henrik. There's a comment here. DeFi is new to me. However, I feel DeFi can be a new way for money laundering. Are there any regulations or laws set to prevent the wrong using? Yeah, Jeff Nicey. Okay. Yeah, go for it, Sorel.
Yeah, I mean, it's That's a really good point, and it's really complex. It's a complex topic because you get into this, you know, the decentralized nature and the global nature means that one country might be doing something, and you know, regulators in general are sort of like putting a square peg in a round hole. You know, regulators are learning at this rate around what DeFi and, you know, blockchain can do, and innovation is going at this rate. So you have individual regions overlaying certain types of regulation, or trying to overlay certain types of regulation, or exploring certain types of regulation, but it's patchy and it's inconsistent. And so you know, at the moment, I don't think there's a comprehensive way to stop that money laundering, but I know it's on the radar of all sort of first world governments and regulatory bodies. It's a really complex topic.
I'll add to that as well. That's a good point, Sorel. That and also Jeff Nicey makes a comment here that it's really hard to launder money on a public blockchain, and there's been fraudsters who have been stuck and have had to even return the funds they've defrauded because of the transparent nature of blockchains. And there's an issue right now with a lot of regulations being designed with a counterparty in mind, whereas with DeFi or other blockchain technologies using smart contracts, there's no counterparty and everything's peer-to-peer. And I see regulators, as Sorel said, eventually catching up and designing regulations that are going to be more fit for purpose in this space.
And actually, the flip side of that, as whoever commented on, is very rightly so, it might have been Jeff, is that contrary to regulators' popular belief, blockchain, you know, transactions are infinitely auditable. So once they do get up that knowledge curve, then I think you're right. Then there can actually be really robust mechanisms and regulations in place to stop money laundering. But it's like we're still, it feels like we're in this education phase at sort of government and regulatory level.
There's a question here. Interesting that two key parameters, customer protection and level of trust, are rated low for DeFi relative to TradFi. Do our presenters agree? Question.
I knew that'd be controversial.
Yeah, I think definitely it's the case that with DeFi, we are trying to build platforms that don't require that trust. So that's sort of the whole point with DeFi. I think one of the other presenters mentioned Celsius, which is a centralized platform where customers cannot withdraw the funds. And I think that showcased kind of the benefit of DeFi. Not saying that DeFi is without problems. There are, you know, bugs in software, there are hacks and all kind of things going on in DeFi, and it's very risky. But that's sort of what we are building towards in DeFi.
Well, did you have any comments?
Yeah, mostly agree with Henrik. What Henrik has said. That I think these is still trust in the trustless system. So the trust in the trustless system is actually shifts from being the trust in the counterparty by being the trust in the security of the contracts that are backing actually that relationship back and forth. So long as unless you're a coder and you actually understand how actually the contracts actually are written and what are the possible bugs, and you're essentially a security expert, you still, to a large extent, you're still trusting that the developers actually developed the DeFi solutions or the smart contracts to the best standards in security. So the trust shifts from people to software, but the trust is still there despite the fact that it's a trustless system in that sense. Right.
Thanks, Will. A bit controversial, this one. Why is Swift so slow, and why hasn't it been updated to compete with crypto?
that's a good question. I don't have an answer to that. I wish I did, and I think that's where DeFi has a really strong competitive advantage. Payment rails. It's amazing to me that I can send someone 3 cents in Ethereum, maybe not with the gas fees at the moment, but on another blockchain to someone in Europe, and I send a $5 international money transfer, and it'll cost me $15 or $25 or whatever it is. I don't have an answer to that, so I wish I did.
Another question on ESG. How would institutional investors like pension funds satisfy the ESG requirements if they invest in DeFi?
By ESG, do you mean things like carbon emissions, or what do you mean? Because the carbon emission story, I think, is sort of misrepresented in general, and Will and Henrik probably have a firmer view or more accurate view than me. But yeah, I mean, the data points I've seen certainly don't suggest that. If we're talking about energy, for example, yeah, I don't think the computing power that this ecosystem generates is has that sort of impact from an ESG perspective. I don't know, Henrik or Will, do you have a view on that?
Yeah, so we actually published an article around ESG and blockchain, and you can probably find it on apollocap.io if you're interested after this seminar. But obviously there is a lot of focus on the E when it comes to ESG. I think there you have to look at the different blockchains. Perhaps there are some big developments happening on Ethereum as well later this year, where there will be a huge reduction in kind of energy consumption. But I think blockchains in general scores excellent in the other categories as well when we talk about ESG.
Yeah, and I think to complement the point from Henrik, there is on the ESG side, there is another. Again, it's not investment advice, but kind of investment opportunities that has been put forward since the story around computation and issues that actually were happening both on the Ethereum and the Bitcoin networks through their proof of work, and since then there has been some significant actually amount of investments into computation that has been using actually clean sources of energy, be it hydro or else, and therefore a number of investors that wanted to use actually the provenance capability of the blockchain to track all the way to the source of the first issuance of a particular Bitcoin and what is the source that Bitcoin is produced, and willing even to an extent to pay a premium on a clean Bitcoin, if you will, issued rather than a dirty Bitcoin. So I think there is aspects of doing that, but that doesn't remove the ESG due diligence requirement, which is about proving that the source is truly clean of the issuance of the Bitcoin.
There's a question for Will. Can you please expand on the example with SocGen covered bonds and how that works?
Yes, I can. Okay, so it's not a particularly changing like revolutionizing example. So essentially what SocGen has done is they tokenize a significant portion, a portion of their covered bond issuance, which they have billions of it on a yearly basis, and they tokenize a part of that and issued natively on the public Ethereum blockchain a couple of years ago. And they were looking to refi part of actually that issuance of the covered bond by actually having a wholesale lending for that refi of the covered bond, of the covered bond tranche that they had actually tokenized through Maker. So essentially using Maker as a wholesale funder of DAI against the pledging of that covered bond, of those covered bond assets that actually had been tokenized. So essentially the assets represent the underlying, but the underlying have also backing by real world contracts, right? That actually says this derivative of a underlying covered bond issuance actually has a direct relationship to the underlying actually real bond and cover pool that actually represents the cover bonds within the blockchain bank. And against that, they use that to plug into the Maker protocol and self-issue actually DAI against the pledge of their covered bond transactions. Given the covered bonds are much less volatile than crypto native assets, therefore the pricing of observability that it's not in the same sense that Ethereum or Bitcoin, which the Maker protocol actually has to observe the price discovery on essentially like on a real-time basis, right? So it's more like on a daily basis. There is an intermediary that observes the price fluctuation of that the covered bonds that actually are backed by real estate, originated by blockchain.
Thanks for these. A lot more questions, and unfortunately we've run out of time. Please reach out to us all on LinkedIn if you want to keep the discussion going. Thanks to the CFA Society, Christina, Kylie for putting this together. It's been a really successful session.